Welcome to this explainer. Today, we are diving deep into the psychology and structure of price action. We're going to tackle a very common yet frustrating problem. We'll look at exactly why you might be stuck in a cycle of repeated losses, even when you feel like you are doing everything perfectly right. Let's get started.
Let me ask you an honest question. Have you ever learned one specific chart pattern, maybe a head and shoulders, or just a standard breakout, and suddenly you started seeing it on every single chart? The pattern looks exactly the same, the setup looks perfect, so you take the trade. But the result keeps changing, and you end up losing your hard-earned capital. Why exactly does that happen?
Well, let's uncover a simple psychological truth. You see, our brains are actually wired to search for familiar shapes. Once you learn a specific pattern, your brain desperately tries to connect the dots to find it everywhere, even in places where it doesn't actually exist. But here's the harsh reality of the stock market. Just because you see a familiar shape, it absolutely does not mean a valid trade actually exists.
Think about it. When we look at a standard candlestick chart, the untrained eye usually only searches for basic red and green shapes. We see a green candle, and we instantly think about buying. A red candle, we think selling. We look for that simple triangle shape, but we completely ignore the broader market story. If you're only looking at the color and the basic shape, you're missing the actual truth of the market.
Section 1. Trading Bias and Mind Games.
Now, what's really interesting is how our own psychology plays tricks on us. There are two dangerous biases every trader faces. The first is confirmation bias. Basically, we search for information that supports what we already believe. If you think the market will fall today, you're only going to notice the red candles and completely ignore any bullish strength. The second is recency bias. If you win a trade on a basic breakout today, your brain gets tricked into believing that exact same pattern will always work, simply because it worked yesterday.
And this traps us in a very toxic loop. Let's say you win a trade based on a lucky pattern. That gives you a sense of false confidence, which very quickly turns into overconfidence. And what happens next? You start overtrading. You blindly take every setup that looks like your favorite pattern, completely ignoring the context. It's a well-known fact that almost 90% of retail traders blow their accounts in the first 90 days. And honestly, this toxic loop of chasing patterns is exactly why.
Section 2. The price action iceberg. To truly understand what we're missing, think of the market like a giant iceberg. The visual pattern you see on your chart, the double tops, the flags, that is just the tiny tip visible above the water. But hidden deep below the surface lie the true market forces. I'm talking about market structure, liquidity zones, the overarching trend, and higher time frame context. If you are only trading the tip of the iceberg, that massive structure below is going to sink your trade for sure.
Let's actually see this in action. Retail traders often jump at a basic breakout pattern, like seeing the price cross a resistance line, and they immediately go long. But they forget a golden rule of price action. The first breakout from a tiny consolidation usually fails. The market pulls back, specifically to trap those early, impatient buyers.
Section 3. Context changes the story.
You see, the crucial point here is that the shape of a pattern might be absolutely identical, but the environment it forms in completely changes its probability of success. Take a look at these two scenarios. On the left side, the market has already rallied hugely into a major resistance zone. New buyers entering here simply get trapped as smart money books their profits. But look at the right side. Here we see the same continuation setup, but forming cleanly within a healthy trend. It's the exact same shape, but a completely different context, which leads to a very different outcome.
This is why, before marking zones or looking for advanced smart money concepts, you absolutely must define the basic market structure. You need to ask, are we in an uptrend, a downtrend, or just stuck in a consolidation range? You have to identify those major levels where the price has been rejected before, and instead of desperately chasing breakouts, just wait patiently for the price to sweep liquidity. Sweeping liquidity simply means waiting for the market to trigger other retail traders' stop losses at those major levels before you enter. Let the impatient traders get stopped out first.
So, you might be wondering, what does a professional trader actually look for before taking that exact same chart pattern? What makes their approach so completely different from a losing retail trader?
Well, professionals don't just look at a shape. They run through a very strict mental checklist. They ask themselves, where exactly did this pattern form? What is the overarching trend right now? Where's the liquidity sitting? Is the volume actually confirming the move, or is it fake? And crucially, what does the higher time frame show? If you see a bullish pattern on a 5-minute chart, but the 4-hour chart is in a heavy downtrend, a professional knows better than to step in front of that moving train.
Section 4. Breaking the losing cycle.
Let's talk about how you can actually apply this to completely break that cycle of repeated losses.
To survive the markets, you must build discipline. Here is your protocol. First, trade only one setup until you master it completely. Second, create a strict checklist, just like the professionals do. Third, journal every single trade so you actually know your true win rate. Fourth, save your chart screenshots so you can learn from your mistakes. Review 50 to 100 examples. You need to think strictly in probabilities before risking any of your hard-earned money.
And this brings us to a very powerful truth. The market is a unique, ever-changing environment of liquidity and volatility. If you keep taking losses on what looks like a perfect pattern, just remember this. The market may not be repeating the same pattern. Sometimes, it is actually your own brain repeating the same biased interpretation.
I really want to leave you with this defining thought. Professionals don't trade the pattern name. They trade the story around the pattern. It's time to stop blindly trading the simple shapes you see in a textbook and start reading the deeper story that the market structure is actually telling you. To be truly successful, you must master the pattern, understand the context, control your psychology, and maintain strict discipline. When you combine these 4 pillars, you finally protect your capital and start trading with real confidence. So I leave you with this question. Tomorrow morning, when you open your screen, what story is your next chart really trying to tell you? Take a deeper look.